Good day and welcome to the Q4 FY26 earnings conference call of Aditya Birla Sun Life AMC Limited, hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Ms. Meghna Luthra from InCred Equities. Thank you, and over to you.
Thank you, Rutuja. Good evening, everyone. On behalf of InCred Equities, I welcome you all to Aditya Birla Sun Life AMC's fourth quarter and full year FY26 ended earnings conference call. We have along with us Mr. A. Balasubramanian, MD and CEO, and Mr. Pradeep Sharma, CFO. We are thankful to the management for allowing us the opportunity to host them. I would now like to hand it over to Bala sir for his opening remarks. Over to you, sir.
Yeah. Thank you, Meghna, and good evening to everyone. And thank you for joining our Q4 FY26 investors call. And I hope you all had the opportunity to read through the earnings presentation, which is available both the stock exchanges and our company website. Let me begin by sharing our perspective on the current macroeconomic environment, followed by update on the quarter ending FY26 for our mutual fund business. The ongoing conflict, as is known in West Asia, and the wave of global uncertainty are fundamentally changing the world order, and surging energy prices have changed the global macro perspective and are posing challenges for global economic growth. For India, there is disruptions in the Asian market, where thanks due to the geopolitical risk, have driven energy costs higher and depreciated the Indian rupee versus US dollar, which continues to remain a risk in the very short term. The risk-off sentiment has prompted FII's outflow and broad-based equity market corrections across the emerging market as a result of that. The IMF now projects global growth to moderate to 3.1% in 2026, down from 3.4% in 2025, with the headline inflation expected to rise modestly. The peak of tariff-related uncertainty is behind us, and potential productivity gains from AI provide a meaningful structural tailwind over the medium term. India has demonstrated commendable resilience through this period. Domestic growth momentum remains fundamentally healthy, and I expect the GDP growth to be about 6.75% for the year, preserving India's position as the fastest growing major economy. Weekly inflation is expected to rise modestly. However, it remains at a comfortable position within RBI tolerance band, with a subdued core inflation and healthy food stocks providing additional buffers. And India's growth outlook continues to be underpinned by strong domestic demand, improving investment activity, a supportive monetary policy stance, and a healthy bank and corporate balance sheet. And turning to the equity market, the last quarter witnessed a sharp transition from optimism to caution, with market correcting from near record highs, driven by persistent FI outflows and global risk-off sentiment rising crude prices. Encouragingly, sustained participation from domestic mutual funds and retail investors cushion the decline, underscoring the growing maturity of our domestic liquidity and reinforcing that disciplined long-term investing and trusted guidance have never been more valuable. Coming to an update on the mutual fund industry, the quarterly average AUM for the industry as a whole stood at 81.5 lakh crore as of March 2026, compared to 67.4 lakh crore as of 31st March 2025, registering a year-on-year growth of 21%. The industry recorded its highest ever SIP contribution, approximately 30,000 crores for March 26, representing year-on-year growth of 24%. Total mutual fund folio stood at approximately 29 crores as of March 2026. During Q4 FY26, the industry saw total NFO collection approximately 11,200 crores across the equity and debt funds, with the equity collection driven by predominantly flexi-cap fund, multi-asset fund, and smaller mid-cap fund. And despite equity market volatility, industry witnessed continuous flows into various schemes, highlighting sustained investors' confidence in the long-term growth potential of Indian equities. Individual average AUM for March 2026 stood at 47.4 lakh crore, contributing to about 60% of the total industry size. And B30 cities with an average AUM of 14.4 lakh crore accounted for 18% of the total AUM, growing by 19% year on year. Coming to the ABSL AMC performance highlights, at the ABSL AMC, our overall average AUM, including alternate assets, now stands at 4.74 lakh crore, growing with 17% year on year. Our mutual fund quarterly average AUM stood at 4.36 lakh crore, representing 14% year on year increase. With this, our equity mutual fund quarterly average AUM stands at approximately 1.97 lakh crore, growing by 17% year on year. Our SIP contribution for March 26 has seen reasonably good pickup to 1,204 crores, growing by 11% quarter on quarter, where we closed about 1,080 crores, 1,204 crores, supported by 40 lakh contribution coming from SIP accounts. Building on this momentum, we are at the forefront of driving our SIP adoption through our Subsidy Important Plan campaign, reinforcing the value of investing through the market cycles. And systematically, our ambition at ABSL AMC is to reach every household in India, making Har Ghar Mein SIP as a reality. We are working in that direction, which will help us in improving the SIP number further. Total investors folio for March 2026 stood at 1.1 crore. The new SIP registration for the quarter, approximately 6 lakhs, growing by 16% on a quarter-on-quarter basis. Is another area where we have shown improvement in the current quarter. The SIP registration actually higher than the previous quarter, reflecting on both the number of registration happening in the quarter. Over the last year, we at ABSL AMC have made meaningful investment in strengthening the investment team on people and sharpening our portfolio construction processes and investment framework, reinvented investment framework in order to deliver consistent investment performance. This has in fact resulted in a sustained improvement in our investment performance in equity, directly translating to growing investors' confidence and distributors' confidence and consistent flows across our core funds offering. In fact, the current quarter, we continue to see momentum coming in our flows in our Flexi Cap Fund, Balanced Advantage Fund, Multi-Asset Game Fund, Small and Mid Cap Fund, Gen X Fund, and Multi Cap Funds. Market expansion has always been a key priority for us and continue to deepen our presence across our emerging market. And today we are present about 19,000 PIN codes spanning across the country, reflecting our commitment to bring in quality investment solutions to every corner of India. Building on this foundation, we plan to add several new locations in FY27, further expanding our geographic footprint. In fact, during the current quarter, we have seen our retail productivity improving across all markets, which is reflecting on number of distributors getting added to our fund, as a number of distributors getting activated across different markets in order to further drive our business. We have enhanced our technology platform and digital capabilities with a clear focus on delivering a seamless experience, including the launch of a new investor app, is reinforcing our commitment to simple, transparent, and accessible investing. We also launched the new partner app, which enhances capabilities, and we remain focused on leveraging technology to drive smarter wealth creation and long-term value to our investors. In fact, in our digital platform, we added some of the features which will actually bring in the number of customers additions and having customers with multifolios and so on and so forth, and also improve the service standards in our app, which will in fact help us in terms of adding more customer base as time to come. Moving to our alternate business, the PMS and AIF category has maintained a strong momentum, complemented by a comprehensive suite of trade offerings. Our PMS and AIF assets grew significantly from 11,300 crores to 32,000 crores, which again growth of about 3 times. This is also supported by ASIC mandate that we won last year. And as you all know, Samir Narayan, who is our PMS head, managing the investments as a head of investment, now is taking additional responsibility of our offshore fund management, along with building the business and expanding our global investment capability as head of offshore business, both on money management as well as on building the business and PMS. With this deep commitment and passion, I'm sure that these two asset classes will start building some more outcome as time to come. We continue to raise funds in some of the funds that we launched last year. In India ASG fund based out of GIFT City, ABSL Flexi Cap Fund for Inward Remittance and GIFT City, and Global Blue Chip Fund, which has given a huge experience for the investors to provide globally competitive solution to investors. We plan to launch ABSL Global Emerging Market Fund very soon through the GIFT City. Karan Dave, who was part of our AB Capital talent pool, we are now taking charge of that AI platform in order to provide fixed income credit-oriented, performing credit-oriented funds, where he leads the credit strategy with a focus on scaling our offerings in this space. The ESIC mandate accounted for about 20,000 crores as of March 2026, while PMS and AIF, excluding ESIC mandate, registered year-on-year growth of about 14%, reflecting healthy underlying momentum, backed by strong performance coming from our PMS business as well. On the EPFO mandate, which last quarter I mentioned about, we won the equity mandate. This quarter we signed the agreement, formal agreement we signed, and now we are ready operationally to get the inflows after fulfilling few other formalities in the next few days. I'm sure in the current quarter we'll get to analyze the EPFO money in the fixed income space as per the mandate given to us for the next 5 years. We are currently in the fundraising plan in the Special Opportunities Fund Series 2 and Structured Opportunities Fund in Series 2 and Money Managers Fund in the AIF space, along with ABSL India Select Sector Fund in the equity space. On the real estate front, our AUM grew approximately about 740 crores, registering 14% year-on-year growth. We currently have a fundraising underway for the Aditya Birla Real Estate Credit Opportunities Fund Series 2 and focus on senior secured lending to post-approval brownfield real estate projects across Tier 1 cities. In our passive business, we continue to witness significant momentum with our quarterly average AUM crossing the 40,000 crores mark to stand at 41,200 crores in Q4 FY26, representing year-on-year growth of 25%, and our customer base expanding about 16.91 lakh crore. ETF quarterly average AUM grew by about 68% year-on-year, significantly outpacing industry ETF growth of about 40%. Our passive product suite now comprise 54 distinct offerings across equity, fixed income, commodities, and multi-asset solutions designed to address the diverse investment needs of our investors. During the quarter, we launched 2 new products in the passive segment, which is the ABSL MSCI India ETF Fund. This will be based out of GIFT City, feeding into our fund in India, and hopefully we get about flows from FIIs invested in this fund, and for which we launch this fund. The same day, we also launched BSE Top 10 Banks ETF, wherein we have started seeing some of the flow of investments, especially for those who are dedicated investments they make in the financial services index. I am happy to announce that we have incorporated our wholly owned subsidiary, Aditya Birla Sun Life AMC International IFC Limited at GIFT City, and have subsequently obtained the retail license to further strengthen our presence. In the earlier presence in GIFT City was in the form of a branch as an external arm of Aditya Birla Sun Life AMC. Now it has become a 100% wholly owned subsidiary company. With this, we will be able to launch product for inward remittance and outward remittance for as small as a ticket size about $3,000, as even as low as $2,000. We launched our SA vertical under the Apex SA brand with our first offering, the Apex SA Hybrid Long Short Fund. With the evolving investors' needs and the rapid expansion of India's affluent segment, this category represents significant growth lever for us. Building on this momentum, we plan to introduce a pipeline of new offerings as guided by SEBI new circular, the near term to further strengthen and scale this platform. In line with this, we have further enhanced our investment capability with the addition of 2 specialists, bringing deep expertise in long short as well as derivative-based strategy using options and futures market. Moving to the financial numbers, Q4 FY26 revenue from operation is at 458 crores as compared to 429 crores in Q4 FY25. Our Q4 FY26 operating profit was about 252 crores as compared to 233 crores. Our Q4 FY26 profit after tax was 187 crores as compared to 228 crores. This is actually on account of increase in reduction of other income due to the mark-to-market actions for the quarter. Revenue from operations for the full year FY26 was 1,845 crores as against 1,683 crores. FY26 operating profit was 1,014 crores as compared to 944 crores. FY26 profit after tax is 973 crores as compared to 913 crores FY25. We are pleased to announce that the board has proposed a dividend of 25.5% per share, is somewhat equivalent to about 78% of our profit distributions for the current quarter for the full year. With this, I would like to open the floor for any questions. I will be joined by Pradeep Sharma, to take any other questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Mangal from Centrum Broking. Please go ahead.
Yeah, good evening, everyone, and thanks for the opportunity. So my first question is on the regulatory impact. So, from the 1st of April, we see that there will be a 5 basis impact on the equity AUM. So how do you intend to mitigate the impact, and what would be the net impact on our books?
Yeah. See, I think this is the broad impact generally post the regulatory changes is in the range of about 3 to 4 basis points roughly. But however, given the fact that the way the industry has been operating, the way we have been operating, we will try and do the structures in such a manner that it does have least impact as far as the P&L concerns, given the fact that the reduction is actually quite marginal and suitably making the structures that we have both on the commission structures and other expenses. Keeping all those things in mind, we'll try and make it neutral to everyone and win-win for the overall business without having any kind of deep impact either for the distribution community or for our AMC business.
Okay, so you intend to pass on to the distributors basically, and there'll be like 1 or 2 basis point impact. That is what you intend to say?
No, we will not quantify any kind of exact number. I think we will of course roll it out the current quarter. And as of now, the assumption that we are making as far as the AMC impact concerns will be very marginal. Yeah, we would look at from all angles how do we maintain the overall profitability. At the same time, when we also look at passing on, optimizing the entire thing, we'll also of course, since it goes across the entire distribution community, we also feel even from a distribution point of view, even if it is marginally passed on, the impact will be the least.
Understood. So how has been the flow market share versus the book market share this quarter?
In line with the market only. So in terms of market share, you are saying?
Yeah, market share. Flow market share versus book market share.
It's in line with our market share.
In line with the market share, yeah.
Okay.
Yeah,
So,
in line with the market share. So we have seen improvement in terms of our flows. I think if you have to just give you some kind of color, one, we actually this quarter is better than the previous quarter in terms of flow of funds coming into the funds that we have been promoting, backed by reasonably good acceptance. More and more approvals are also coming in from the banking channel. That something is good news. Second is the way we looked at it, as you all, we've been saying for the last only 1.5 years, we'll continue to focus on reducing the fall in the market share that before we start rising. That's something again has happened in this quarter too. I think the overall reduction is a very, very marginal, very, I think narrowed quite significantly. With improved flows, broadly, I would say we should come reasonably close to the market growth momentum very soon.
Understood. So my last question is on few bookkeeping questions. First is what is the SIP AUM? Secondly, if you could quantify the ETF AUM. So your fixed income includes the ETF AUM. So if you can give me the ETF AUM. And lastly, the PMS and AIF revenue for financial year 26 and Q4 financial year 26.
Sure. So I'll take the second question, which is the ETF equity rather than out of 41 crores. Roughly about 500 crores is the ETF, which includes gold and silver. Roughly about 11,500 crores. Roughly 11,500 crores. Okay. And the balance is actually fixed income target maturity fund, we can call it. As far as the other question, SIP book is about 76,000 crores is SIP book. With respect to revenue, overall in the one second, just hold that.
Yeah.
So as far as the PMS and this revenue, I'll just tell you.
Yeah.
Revenue coming from PMS and
Yeah, so revenue share from PMS and AIF alternate is around 6% on gross basis, Mohit. And on net basis, it will be around 3.5%.
Yeah.
Okay, understood. So sir, just one follow-up. You said SIP AUM is 76,000 odd crores. Last quarter it was around 87,000 crores. So it's just the employee movement, right?
Yes.
Understood.
It's purely MSIM only. Yeah.
Pure MSIM, right? Okay. Thanks, Mr.
Yeah. Thanks.
Does that answer your question, Mr. Mohit?
Yeah, please. Thank you so much.
Thank you. Participants who wishes to ask a question, please press star and 1. The next question is from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hello. So good evening. Just few questions from my side. First, you mentioned in your previous comment that your flows in the funds that you have been pushing, or funds or performance is good. There has been improvement in flows quarter on quarter. But if I look at the overall active equities as a cohort for you and look at, let's say, 4Q versus 3Q or 4Q versus last year 4Q, how the quarter on quarter and YOY look like for the entire active equity basket as a whole. My second question is on the expense side. You mentioned in your commentary that you kind of have expanded your team on the SIF side. You also have ambitions to continue to scale up your alternates and PMS businesses, offshore businesses. So when I look at the employee expense growth, how should one think of, let's say, for the next 1 or 2 years in terms of the growth? Finally, I have a few data keeping questions. One is SIP flows for the quarter. The second is ESOP expense for the quarter and year. And third is the number of employees outstanding as of March 31st.
Sure. As far as the flows concerned, Dipanjan, I think the last quarter also I mentioned, and this quarter also so the way I look at it, what you're trying to build in addition to arbitrage fund, which also considered as active equity, and we have seen good pickup in the first half of this year in terms of our arbitrage fund. And then we started seeing pickup coming in flexi cap fund, multi-asset allocation fund, multi-cap fund, and the balance advantage fund. So that's why I think we continue to see inflows, and even we are also promoting these kind of 5-6 focus products. And the thematic side, we continue to see flows in Gen X fund. And now we are seeing good pickup in the small and mid cap fund. We are now seeing flows in the small and mid cap fund. So that is the way we are pushing it. And third, of course, where we are also losing some assets in the early part of the year is real assets schemes. Thanks to significant improvement that we have seen in the performance. In fact, our outflows have has come down quite. Though the asset as a category is not getting flows, but we had a bit of excess outflow initially for underperformance of the schemes. That got narrowed quite significantly. This year we have seen a significant pick. In fact, I must also share with you the number of funds that have delivered Q1, Q2 performance in equity now has gone almost about 85%. In fact, current quarter we have almost a significant portion of our funds is in the Q4, and that something is being accepted. In fact, during the current quarter, we got our products approved, part of the banking channel, which is also one of the fees we are working on it. Now, wherever we got one product added, now 2 products got added from the list of funds that I just showed to you. So I think each quarter-on-quarter basis we are improving it, and hopefully this year we'll see the momentum continuing as far as the flow is concerned. That's why we are pushing the team for improving the productivity point of view. Then other 2 questions, I'll ask Pradeep to just give you insight.
Yeah. So the other one was on the employee expenses you were talking about. So basically, see, we launched a new employee ESOP scheme in Q4, which we had impact in the current quarter, and that will continue in the next year in coming quarters also. However, that impact is not that really visible in the Q4 numbers. If you see, there's not increase from Q3 to Q4. Largely on account of there was some employee-related reversal because of the performance, variable pay performance. That has been offset during Q4. However, going forward, there would be an impact of around 8 to 10 crores per quarter in next year.
Next year?
Yeah, next year. So this would be on account of ESOP and all. As far as you said on the employee, the 2 new employees, I think that should not be much impact. That is only a running employee cost, and normal inflationary employee cost should be there.
Yeah. As far as your employee cost, in addition to the thing mentioned, I think from a team point of view, we are more or less there, except we will add, we have our ETF passive gentleman left. So we'll be adding 1 or 2 member team to build our passive business. Of course, we have an existing team, no doubt, but to head that business, we have some serious plan in order to bring in higher focus on passive growth as well. That's something which we'll do. And second, of course, some people have left and therefore some people are coming in. So largely, if I look at it from employee cost point of view, there will be a marginal increase, not big time increase. But also simultaneously, we also keep looking at optimizing the existing resources, what additional responsibility they can take, and therefore this will remain somewhat under control. As far as the ESOP concerned, while you mentioned about next year impact will come, in fact I must mention we rolled out our ESOP plan this year well on time at close to about 845 rupees price. In fact, this also boosted the confidence and motivation of the people. Almost about 110 employees we covered. Therefore, I would probably say that with the improvement in performance, and the team also got motivated post issuance of our ESOP, and this also should add to the overall positivity for the fund.
Got it. If I can get the data point that I asked for, SIP flows for the quarter, number of employees, and yes, those were the 2 questions.
Yeah, sure.
So SIP flows are the 1,204 crores.
Oh, sorry,
One second, just give me a second.
So 1,208 crores is for the March, and if you see for quarter, it is 3,600 crores. And employees are 1,615 employees as of March.
sorry, 1,615 you said, right?
50.
Yeah, 1650.
Okay, so just one follow-up maybe. I mean, if I look at this year, I mean, you started with around 1,630 employees, you went up to around 1,700 plus, and now you're back to 1,650, despite the business momentum, picking up. So, what is really getting captured in this employee count number?
So we always see there will be always some ongoing vacancies at RM level, etc. at the bottom of the pyramid. As well as we always keep on optimizing our employee strength and also keep on improving the productivity levels by way of implementing the new tech solution, etc. So I think 50 employees plus minus will keep on happening always, depending on the optimization.
Also we onboard certain segment of the business, off-roll people, then they come on the onboard. So roughly about 80 to 100.
Got it. Thank you and all the best.
Yeah, thanks.
Thank you. Participants who wishes to ask a question, please press star and 1. Next question is from the line of Sarnab Mukherjee from 360 ONE Capital. Please go ahead.
Hi, sir. Good afternoon, and thank you for the opportunity. 3 questions from my side. First one, sir, on this regulatory impact, so I just wanted to understand, and will we be getting some clarity on, what is the full extent of the impact? Because we are already in the third week of April, and I think so. Would it be like that we will have an idea as we close April or it be like that, optimization will continue for a few months as we move in there. So if you could give some clarity on that. Secondly, in terms of customers, how has the movement been during the quarter? The reason why I asked is that in the SIP slide, growth that we are seeing in terms of flows as well as new SIP registration, that is not reflecting so much in terms of the contributing SIP accounts. So I just wanted to understand the dynamics there. That are our existing customers opening, incremental SIPs, or how is it playing out in terms of onboarding, say, new to ABSL AMC customers? And also, if you could help us understand that in terms of this incremental SIP flow growth that has happened during this quarter, which channels are providing that? Is this coming from online channel or any other kind of distribution partners who we have added? If you could give some color on that. And lastly, sir, also if you could share the yields by asset class, that would be very helpful.
Yeah. So as far as the first question concerned with respect to the optimizations, I think, see, this is after a multiple round of discussion when the first circular came and the final circular came. All of you would have known, and as an industry, we worked with SEBI and brought it to a scenario where it will have least impact, including the broking firm with whom deal with on the equity side. So in fact, I was personally involved in ensuring that, rather not ensuring, working with the other team members of the industry to see to it that it has least impact. So that's the broader approach in which we did. And whatever the panel that has come, the way we have worked out at this point of time is from ANC profitability point of view, we'll try and make it neutral, if not positive. As far as the distribution concerns, and we are in any case in a scenario where we have always been ensuring that the distribution partner should work with us very closely. Therefore, we kept the commission structures in a manner it remains somewhat attractive for them in order to grow our business. There will be some marginal reductions could come. So that's way broadly I'll see it without having too much impact as far as them concerned. So the way we are currently working out is from our profitability point of view, somewhat neutral kind of model. That's why we are working on it. That's why we are looking at building the whole plan. And as far as the SIP is concerned, of course we have seen some bit of cancellations this quarter. Maybe I would say increased cancellation during the period of volatility. It used to be somewhere around about 40 to 50% for the industry I'm talking about. It went up to about 92% for the industry. In fact, our SIP cancellations were actually lower than the industry, I would say. At the same time, this normally happens. Any such kind of volatile period, we do see SIP cancellation increasing. But that in my view is not generally the worry part. The SIP registrations have not come down quite significantly. SIP registration remains somewhat strong. So when our number for the quarter, if I see about 6.71 lakh as against 5.4 on the previous quarter, is the trend that we see. So therefore, this is something, one good big achievement I would say as the industry all have done, including ourselves, making SIPs agnostic to the market volatility. In fact, I myself was during the volatile period keep harping on the importance of not cancelling SIPs. In fact, I came with a mantra which called, if you have an SIP, continue SIP. If you have cancelled SIP, start your SIP. If you never invested in SIP, start SIP. Something like we actually came out with a campaign during that period. It was being appreciated by people because during the volatile period, giving guidance to the investors is extremely important. In fact, we are the fund house where all around the place in re-emphasizing importance of SIP. In fact, that has been appreciated by a lot of our partners and investors that Birla is actually batting the front foot in promoting SIP, which hopefully should help us in building a SIP. That's one. As far as the channel concerns, in fact, we have seen digital, of course, remains the dominant component, no doubt. MFDs, we have seen improvement during the current quarter due to the high engagement coming from our sales team, because improvement on performance the narrative gives a more confidence for them to actually go out in the market, not having a fear of reaching out. That's something is helping our sales team actually go out in the market, talk about with a lot of proud that yes, we are doing well. So that is helping us in improving our contribution coming MFDs. Of course, long way to go, no doubt. Secondly, product coming as part of the approved list of banking channels. Also is improving the contribution, both the flows and SIPs. And third, of course, is the ND channel. Before the ND channel, our direct team channels, also we are seeing an improvement in the direct team channels, both the HNI space as well as the PF and trust. We also have channels coming in the institutional space. That space is also, we are seeing STPs now, contributions coming in. In fact, last quarter, some of the even institutional customers who predominantly invest in equity as well had an equity when the market fell. So that's way broadly I see it. As far as the yield concern, I'll just give it to Pradeep to give you insight.
So, yields in equity category are around 60 to 63 basis points, and that side it is around 24 to 25 basis points. Liquid is around 12 to 13 basis points. ETF is around 6 basis points.
Okay, sir, understood. Thank you for the detailed answer. And yes, sir, I think really, great set of numbers on the SIP side. So just one follow-up, if I may, in terms of the month of April. So just wanted to understand that, how are we seeing the month of April now that, the volatility has kind of reduced a bit and the markets have also started to show some encouraging signs. So just wanted to understand, how you are seeing incremental uptake in the month of April.
Sure. So I think March quarter, I think there was also pressure on fixed income side due to the rupee volatility as well as interest rates. Banks are under tremendous pressure to raise deposits. That did have an impact as well as the fixed income flows concerned. In fact, post RBI giving more liquidity and the borrowing calendar is more skewed towards the short run rather than the longer end. As again, bond markets have come back to normal, liquidity has come back to normal. Flows also come back normal. In fact, as I speak, our number has come back now close to about 445 in terms of running number. So that's something as an overall basis, I would say. As far as equity is concerned, we did have a conference. Normally we have in the beginning of every year. We run a conference taking all our distribution partners to one location. We lock ourselves to talk about what we have done last year and what we intend to do next year. In fact, we got a reasonably good response coming from distributors from across the representation of India, and that's something. Got a feeling that everyone wants to actually add and accumulate during the fall period, rather than reducing the exposure. That's one feeling I got. So therefore, this in my view, assuming these about 400 distributors participate in our conference, assuming I take that as a voice of representation of the whole community, probably we should see the flows not getting impacted, given the fact markets also come back quite nicely. From our side, we are seeing improved contribution. Though I don't want, it's too early for me to give that number, but I'm seeing improved tractions. In fact, I must mention post our conference in Hyderabad that we had last week, entire my sales force have become extremely confident in order to improve their own productivity in every market where they are. So that's the way I would put it.
Understood, sir. This is all very helpful. Thank you so much, sir, and all the best for FY27.
Thank you. The next question is from the line of HT from Premji Invest. Please go ahead.
Hi, sir. Am I audible?
Yes, you are.
Yes, you are audible, yeah.
Hi.
Yeah.
Hi, sir. Harshit here. Sir, just wanted to, I joined a bit late, maybe you got covered it, but what was the equity yields which you mentioned, sir? Equity segment yields?
Yeah.
Yeah, I'll just tell you.
So equity yields were 60 to 63 basis points, and that it was 24-25 basis points. Liquid 12 to 13 basis points.
Okay. Sir, when I look at the equity yields, at least if I back calculate broadly, so there is a good around 2-3 basis point yield reduction which would have happened this quarter. So I think if I take every other thing constant, then probably a 3 basis point will decline in the equity segment. Is it anything particular to do here?
No, so there's no specific reason. I think this is the function of telescoping pricing as well as mix of products. So both these things will have impact on this. Versus, if you see for last year, we had also actually in the earlier calls we were saying last year we had some reversal because of the regulatory changes. So if you see from last year to this year, there is a marginal drop of 2 to 3 basis points. I think otherwise there is no specific point. It will continue. Sorry.
So just on the sequential part itself, and wanted to check that probably it looked like they declined.
So there is no specific reason.
Okay. So
continue.
You are saying, within equity you are saying there could be more passive, basically index funds, etc. would have increased. That would have led to that yield decline.
Yes. So product mix,
Yeah, otherwise in the core product there is no fall. Of course, as I mentioned about some of the funds are also a bit growing in size. To the extent the telescoping pricing impact that you mentioned, but that I would say that is one component of it. But otherwise, even growing our passive will also get added to that segment.
Got it. So just the other point you mentioned that the impact of the TR revisions, you would want to keep the distributor also. You would want the distributor commissions not being impacted. And then you said that we also want to ensure that our business is neutral in terms of the economics. But how can that dealing? Do you expect that we will be have to taking some hit?
No, just to clarify that, Ashish, we did some kind of math, just back of the envelope math we just did. Let us assuming scenario that if we're able to make it somewhat neutral or negative, say let us assuming for the distribution partners, what impact it will come. Given our current the brokerage structure we have. So we have current distribution structure that we have. So I would say we would be in the, I would not say too high, I will not say not too low as well. I think we are a little above, say median I can say, compared to the industry people. Therefore, we felt that what the impact will come, that is assuming that 2-3 basis points is actually comes at the cost of to the distribution side. Then we felt the impact is very marginal, right from the people who get a larger AUM versus smaller AUM. And for us also, given the fact this has come, we also re-looked at some of our cost structures, how we can improvise it. Therefore, we looked at across the board how we can actually ensure that impact is less. It's also coming from the fact that, as I mentioned earlier in the call, that whatever said and done, the initial fear which was there when the first circular came, when the final circular came, in that call also I mentioned it will be more or less neutral, if not slightly positive. So that we continue to maintain that. This has to get evolved in my view. Therefore, we can't say this is the way exactly will work. Because anyway, once it is done, implemented, we'll come back to a normal distribution structure, which normally we keep about 60-70% is the distribution structure. We'll come back to the model. Therefore, we should not get confused in terms of who will get the impact and who will get benefiting. We have ultimately come back to the distribution model.
Understood, sir. Sir, one last question. If I look at my net equity flows across all the active funds, basically, I think last year, if I assume that in the interim we had some higher redemptions from the older schemes, then we had some higher redemptions in the online, basically. So are we, because of the performance now being much more stable and a larger track record of stable performance, is it fair to assume that right now we are at a stage that on a monthly basis we are getting 250-300 crore of net inflows as a bare minimum right now? I think just trying to understand that have we reached a point that net of redemptions we are now right now at a point that 250-300 crore monthly inflows are more predictable inflows which we can get every month?
Yes. I think the trend is there, Arshit. I think clearly, you articulated nicely in terms of how we are shaping up. In fact, so I don't normally say last year flows actually is 2 times higher than the previous year flow. in terms of flows. So that's again nothing but an effort that we are doing it. So as I mentioned in my opening remark, whatever steps we have to take in order to bring in the talent side where we have to improvise it, and the responsibility is changing and so on and so forth. Each of the areas, the focus that we brought in, all of them started paying. Even it takes some time for people to get adjusted and start delivering. In fact, when I mentioned about 80% of the funds today in Q1, Q2, is all I think is the outcome of what we see. When the product is coming part of approved list, is also the function of how now is coming in the radar with the rest of the competition and so on and so forth. I think we are going in the right direction, I would say.
So, am I at the cost of so is 200 300 crore number, which we have already now at a stage that now that is the base minimum monthly flows we are there at, or you think that still we are not at 250 300 crore? It's still maybe few months we get it, but it's not that number which we have reached on a more steady state basis as of now.
Yeah, and I would probably say the number would be much higher than what you are indicating. Okay. So I don't want to say it right now, but we would probably push for higher than these numbers.
Understood. This is helpful.
Yeah,
Thank you.
Yeah.
Thanks a lot.
Yeah.
Thank you. The next question is from the line of Meghna Luthra from InCred Equities. Please go ahead.
Yeah, hi, thank you, sir. Just one question is, sir, you mentioned on the banking front we've got some approvals on some products. So can we get some more color on that, and how do we see the strategy in the banking channel changing? I understand it's still a small proportion of the channel mix.
Sure. See, I think the way we look at our banking channel is who are the large key partners for Aditya Birla Mutual Fund. It's basically starting from HDFC Bank, Kotak Bank, Axis Bank, and ICICI Bank, Standard Chartered Bank, and the other smaller bank we can say IDFC Bank and others. Bank of Baroda, large distributors. Well, we used to always presence, but I think each one have to generate in terms of volume coming in, and that we are seeing it across each of the channels. Second is like HDFC Bank, they have tightened their product recommendation after the 2019 financial market crisis. So they don't promote more than 3 or 4 products in part of the list. In fact, I'm happy to say 2 of our products is part of the recommendation list. That's something is also helping us because our engagement is good, connectivity is good, and product coming on recommendations it leads to increase in flows. That's something we are seeing. And we have seen Kotak Bank is also part of our wealth management team and retail team of Kotak Bank do contribute for us. In fact, 2 of our products are part of the recommendation list. As I understand their constraints, they cannot give more than 2 products per fund houses on the basis of the performance selection. So I'm happy to say these are some of the products coming as part of that recommendation list. People on the basis of performance improvement, engagement, their own conviction and understanding of what we are doing would deliver the much desired outcome. So that's the way we are pushing it. And this is something would help us in keeping that momentum continuing.
Got it. On the flows part, would the banking contribution be materially different than the outside, specifically on the equity assets?
So I would say materially different from the past. There was flows that come down quite significantly from this channel because the products are now part of the recommendation list. So now with the engagement being there, that product coming part of the recommendation would lead to actually increased flows. Of course, even I'm pushing the sales team to take full advantage of high engagement with the team, which I think the team is also doing it. On MFDs, they have the regular flows because we have deep connections. Even MFDs, when we connect, we don't look at them only as our distribution alone. We actually add a lot of value addition we give by providing guidance, and we run a program called Legacy Leap. We run a program called Fulcrum in order to encourage the next generation of the distribution partners who have long association with the distribution partners for 30 years. And old generation wants to develop the next generation. In fact, we as a fund house take a lot of leads in helping the next generation to build the business. All such things we are doing it in order to ensure our traditional channel, MFD channel, improves while the organized channel continues to get better. And direct is something we have made an investment. Last 1.5 years, we're making investment on direct team. We're also bringing more sharpness in terms of improving the numbers. And then the last piece actually is the digital channel. Last year, I still remember we got close to about 15 lakh new customers added to the online channels in some of our funds like PSD Equity Fund and few others. That segment also we are pushing ourselves as to how we can increase the contribution from the digital channel as well. So all around these kind of sharper focus, I'm sure each of the channels will start contributing better than the previous year. That should help in terms of keep building the momentum.
Great, sir. And lastly, on the product pipeline, what would be on the equity side?
Yeah, one of course the SAF we have already filed. That's something which will launch very soon. And second, under the new category, we have looked at some of the merit for having the life cycle kind of funds. We're also looking at some of the REIT and InvIT fund. If the SEBI gives approval, that's something we're looking at it. And that is a part of our regular exercise. In fact, we're also looking at our Gift City product. I must mention that we were the launch in Gift City product investing in emerging market without knowing how the emerging market is going to do. In fact, that fund has done exceedingly well, giving good experience to investors, giving about 35% dollar return on a one-year basis. That's something. It was a closed-end fund. We are now looking at launching the open-end fund in the Gift City. We have this plan also is in place. As for the domestic concern, in addition to life cycle fund, what I mentioned about, I think fund of fund well, but we're not seeing much growth. Deserving growth, I would say. That's something again we are pushing it.
Got it, sir. Thank you. That's all from my end.
Yeah.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand over the conference over to management for closing comments.
Thank you, everyone for joining for this call. And with this, we conclude our Q4 FY26. Thank you.
Thank you. Ladies and gentlemen, on behalf of Aditya Birla Sun Life AMC Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.